Good evening, doctors. Team Medflix welcomes you to another exciting session. Team Medflix would also like to wish every one of you a very happy Diwali. I hope you all stay safe and enjoy this Diwali well. Today's session, we would be having Dr. Rohan Desai. Is an MBBS and an IIM Ahmedabad alumnus. He is also the founder and CEO of Plexus MD. The topic of discussion would be financial health for doctors. So now I would like to give it over to Dr. Rohan. So please, I'll stop my presentation. Let's hear what does financial health mean for doctors.
Thanks, Vishali. Good evening, dear friends. Welcome to this session on Medflix. I think this week we don't have too many sessions lined up. This is a festival week, and uh, expectedly, doctors would be pretty busy. So we just thought of keeping this week light, but we wanted to do this one session on financial health. Some of you would have attended the session by Rachna on Sunday, and this has similar themes, some similarities, some differences. We wanted to do this yesterday, but then Dhanteras is a day when a lot of people have pujas, so we thought let's shift it by a day on the eve of Diwali. I really hope you take away something from the session today. Some of you might find it a little basic, and we will. See, the idea of this club, Money Matters, is to sensitize everybody to so many issues around finance and how to improve your net wealth over time. And we have to start somewhere. So we'll start with covering some low hanging fruit. So there are a lot of ways in which we can very quickly and easily repair our financial health. And gradually, over the next few weeks and months, we'll start touching upon various topics in more detail, like take mutual funds, for example. So do one whole session on mutual funds, do one whole session on credit cards, and so on. So, but today the idea is to cover some low hanging fruit. And I didn't want to clutter this talk with 30 tips or 30 takeaways. I really want to focus on three or four things which are super important. These three or four things probably make up 80 to 90% of the financial advice which any good financial advisor will give you. So so therefore, staying light so that we do justice to the three or four things we'll talk about. Just brief background: I studied MBBS from NHL, Gujarat University. After that, went to IIM Ahmedabad to do my MBA. Spent a few years in consulting, mostly in healthcare, and then started Plexus MD in 2014. And recently, we started Medflix. So this has been the journey. The place obviously where I learned a little bit about finance was IIM-A, and then throughout the last 10-12 years of being a professional, have picked up a few more things about personal financial management. So that's the background. This slide also serves as a disclaimer that I'm not. There's nothing on the CV which says I'm a finance expert. My MBA was a general MBA. Take everything we discuss with a slight pinch of salt. And anyway, I'm not going to give any tips, so to say. So I don't have to disclaim about that. Right. So broadly, two things on the agenda today. I will finish my talk in about 20 minutes or max 25 minutes. We'll have time for Q&A. I'm available. So please put your questions in the comment box. I will try and answer them if I can. Otherwise, we'll keep the questions and get them answered by the best person we can find and then share them with you. So two focus areas today: investments and insurance. Let's start with investments. So we'll talk about the number one superpower of investing first. This is a story some of you would have heard. If you would have bought 100 shares of Wipro in 1980, when the shares were 100 rupees each, which means you had invested 10,000 rupees some time back, when many of us would probably not even have been born. But let's assume, what would be the worth of this investment today? Just put down your guesses in the comment box and run wild. Dr. Patil is somewhat close. So it's not 10 lakhs, it's not 50 to 60 lakhs, it's not 1 crore, it's not 120 crores. it would have been worth 600 crores today. Uh, so so that's just insane. Uh, this represents a 6 crore percentage growth. A 6 crore percentage growth is an absurd number. You can't even make sense of it. I can understand 10% growth, 20% growth, 200% growth. 200% means something tripled, right? Not doubled. Something tripled is 200% growth. But what is 6 crore percentage growth? Uh, in simpler terms, it is 38% annual return over 40 years. That makes more sense. Uh, 38. So the money that you put in 10,000 rupees just grew at 38% every year for the last 40 years, and that's the number one superpower of investing, which is the power of compounding. Whenever you will go for some financial session or financial education, it cannot start without or end without a discussion on the power of compounding. Some of you would have seen Warren Buffett's documentary on Netflix, and it's a very interesting story. And there's a whole segment dedicated on this as his golden rule. So if there is one rule which he would tell you, it is that stay invested. So the power of compounding in simpler terms, I'll just go back to the previous slide. Um, so the power of compounding in simpler terms is just staying invested, being in there for the long run. You The 10,000 rupees did not actually grow at 38% every year. Some years it grew at 3%, some years it declined at 3%, some years it grew at 300%, and then for a decade it grew at 100% year on year on year for that whole decade, and then for a whole decade it went into a slump. So many things affect your investments: the macroeconomic factors, the company related factors, multiple things, the currency related factors. So it's only in the long run that you will actually make money. So the most important thing is this. And here there are two things. So one is the whole duration. The duration meaning intraday trading versus month on month trading versus putting your money and investing it for 10 years. So one is duration. The second is consistency. So you cannot try and be a long term investor and try and time the market. It's very very difficult to time the market. More often than not, or most often than not, you'll actually get it wrong, because again, it's a very well spoken about rule that sell when everybody is buying and buy when everybody is selling. But how do you do that? It takes tremendous guts to actually do that. I simply cannot want to sell when everybody is buying, because when everybody is buying, there's an upper circuit every day. There's 10%, 20%. Your share is growing every day. Who will have the guts to sell it? So it's very, very difficult to time it. And most pundits will tell you there's no point of trying to time it, and which is where SIPs come in, which is systematic investment plans. The SIPs is just a complicated word, but it just means putting in some money every month. That's it. And what Rachna was saying on Sunday is there's also a way to do this weekly rather than monthly. So instead of putting in 30,000 rupees every month towards a mutual fund or any asset, and we'll come to assets a little later. If you can even start doing it weekly, you're even smoothing the curve more. So that's it. I think I want to make one point here when we talk about the Wipro story. Um, it is sheer luck. If somebody actually put 10,000 rupees in Wipro that day in 1980 and that person has 600 crores today, 99 out of 100 times he or she is not a brilliant investor. 99 out of 100 times it's sheer luck. So we should never discount the huge role that luck plays in investing, in wealth creation, in life in general. But that's something I think we have to be very cognizant of. The reason you need to understand and appreciate the role of luck is sometimes you do the right thing and the outcome is not right. Sometimes you make a good investment decision and nature or life doesn't give you the right result, and there's no need to reassess it and look back at your decision and say, this was a bad decision. A good decision is always a good decision irrespective of the outcome. So I think it's very very important to give yourself some leeway when you've made a good decision and the outcome is not good. And at the same time, just because you invested in a random script, it grew 3x in 3 months, don't start thinking of yourself as a stock market czar. You will end up burning all of that 3x before you will even realize. So I think it's very very important to assess the outcomes. Sometimes they are your skill, sometimes they are not your skill. In this case, who would have known? Wipro was making oil in 1980, hair oil. Uh, there's no way that somebody could have guessed this 10,000 rupees will become 600 crores and Wipro will be a massive conglomerate at that time. So it's pure luck, other than probably the promoter family who probably had some sense of what they want to do. So let's move forward to the power of compounding. This is a very simple formula. We learned this, I think, in about 6th standard. This is the formula for compound interest. When our teacher would tell you that the formula for simple interest is A is equal to P into 1 plus R, and the rate of interest will multiply every year. You'll get the same rate of interest every year. And compound interest is A is equal to P into 1 plus R raised to N. So this is compound interest. This is not a complicated formula. This is something we've seen. But this is the true power of compounding, that raised to N, that exponential. Your interest keeps accumulating more and more interest, and before we know it, that becomes massive. Your principal is become a really tiny part of the whole wealth you've created. So two important factors here, R and N. N is under our control. R sometimes it's not on our control. We'd all like to control R, but a lot of times it's not in our control. But most asset classes that you'll do. So Rachna was talking about index funds on Sunday. Now, if you believe in the overall India story, if you think that in India has multiple things going in its favor. The demographic dividend, as they talk about, saying a great age group, and a lot of consumption is going to start and happen here, etc., etc. I think that overall India is going to keep growing over the next decade, 2 decades, 3 decades, and everything is cyclical. So maybe there will be a time when this will reverse, but at least in the foreseeable couple of decades or decade, India is expected to keep growing. So and which is the index of India? Is this Sensex and this Nifty. Sensex and Nifty are not a collection of random scripts. They are a collection of the scripts which. So the Sensex 30 or the Nifty is a collection of those 30 or 100, 500 scripts which actually have solid fundamentals. You can't make it to these indices very easily. So just invest in an index fund. You will be guaranteed that R is not going to be negative. As long as R is positive, compounding will work. So otherwise, compounding will work negatively. So compounding will always work. That's on the power of compounding. Now let's move to the next topic of discussion, which is asset allocation. So let's talk about what are the kind of assets. And asset basically means an avenue of investment. So which are the avenues of investment available to you? Please put some examples in comments and we'll take it forward from there. So where can you invest your money? I'll get you started. So shares, which is the stock market, mutual funds, gold, real estate, bonds, land is real estate. So these are and I'm waiting for the C word. Yeah, there you have. So these are all asset options, and I'll talk about a very important asset which all of us always miss. But before that, so let's talk about debt and equity. So any asset option which is relatively safe, which is backed by a sovereign meaning a national government kind of a support, is generally classified as a debt option, and debt is also regularly interest paying. It has a coupon. So if you buy bonds, if you buy a fixed deposit, if you buy the national savings certificate, these are all debt options where you'll get a certain interest rate. The interest rate may be 5%, 7%, 8%, 12%, and so on. Generally, debt is safe. Debt is very safe. There's very, very low chance of you losing your capital. So when we say safe, we always talk about losing your capital. In debt, there is a close to zero chance of losing your capital, and that's why debt is considered safe. Your principal, you will not end up losing your principal. Now, the equity is not safe in the sense that it's risky. you could actually lose your entire money. So if I buy 10,000 rupees worth of a share, which I have no knowledge of, a friend told me is going to do really well in the next months, and which is the commonest story you'll come across, there's a healthy chance that you might actually lose your equity, and not the whole of it, but you might lose 30% of it, 50% of it, and in the worst case scenario, all of it. Even in equity, the good thing is that your losses are capped at the money you put in. So I put in 10,000 rupees in Wipro. The worst case scenario would have been I would have lost 10,000 rupees. That's the good thing about the riskiness. Now you enter an asset class called futures and options, and there actually may not be it may not be guaranteed how much you may lose. You may actually lose more. So it's and these are called derivative options. So derivatives are asset classes which are derived from another asset class. So a future is derived from a share price. So future is the next level of equity, and it's double or exponentially more volatility, exponentially more exposure. We'll not talk about futures and options today. We'll have a separate session on it sometime. But coming back to debt and equity, so the commonest example of debt is FD, and the second common example of a debt type of investment is PPF. All of us in India generally have a PPF account, the Public Provident Fund, and there are good things about PPF. So the good thing about PPF is it is one backed by the government, so it's very safe, very unlikely to lose your capital. It gives you a decent rate of return. It doesn't match the kind of returns which have come from equity markets, but it is EEE, as Dr. Tavkar is saying. It is exempt, exempt, exempt. It is exempt on investment. It is the interest you earn out of it is exempt from tax, and when you withdraw your money, it is exempt. Now, I'll just spend a minute here. So, a lot of places, when you get interest out of it, it is taxed, like dividends. Dividends are taxable in your hands or in the company's hands or both, depending on various things. A lot of times when you take money out, so you put money in a flat, you buy a flat for 10 lakh rupees and you sell it for 15 lakh rupees, the profit you make, 5 lakh rupees, is taxable. In the case of PPF, it is the interest that you get every year is not taxed, and when you take the money out, it's not taxed. Moreover, there is this section 80C in your income tax, and 80C has a limit of 1.5 rupees, and all of this 1.5 lakh rupees can be invested in PPF, which means your taxable income goes down by 1.5 lakh rupees. Assuming you are in the highest tax bracket, this is roughly a saving of 50,000 rupees. 1 year saving 50,000 rupees a year, purely by paying less tax legally. And second, on that 1.5 lakh rupees, you'll make some, say, 7-8% annual interest, which is another 12,000 rupees. So you've actually made 12,000, and this 12,000 is tax free. So you've actually made 12,000 and you've saved 50,000 rupees. So PPF is a great tool to maximize, purely because of the ATC deduction, more than anything else. Advantage of PPF, illiquid. There are various rules around illiquid means it's not easy to encash it. There are unlike shares. So shares are very, very liquid. From the moment you want to start selling your real estate, it'll be probably a month, 2 months, 3 months, depending on the time before it gets sold. And PPF is very, very liquid in the sense that there are many. I was saying it's very difficult to give advice to anybody on saying X% of your money should go into mutual funds, gold, real estate, and so on. But it's easier relatively to talk about the percentage of your allocation into debt and percentage of your allocation into equity. And we were saying debt is safe, but debt is low rate of return, and equity is risky, but equity is also high rate of return. And a very, very good thumb rule to divide your money, investable money, is take your age and put that age percentage into debt. So if you're 25 years old, put 25% of your investable income into debt and the balance into equity, which is 75%. So the logic here is that you're young and you can take more risk. You have a very good working life of you. Even if you end up losing a bit of your wealth, you can always recover it. And as 25-75 changes, and as you become 75-year-old, you should probably put 75% of your money into it's just a basic simple thumb rule. More than anything else, I think what you need to understand is your personal risk profile. If you are risk averse, invest in FDs and PPFs and national savings certificates and so on. And if you're happy to take risk, then invest in any risky asset classes. Mutual funds are obviously equity, mostly equity funds. So most people invest in mutual funds, equity mutual funds, but there are also debt mutual funds. So mutual funds are fundamentally a combination of investments. So you want a manager to take this decision for you. You don't want to spend too much time regularly tracking different equity options, different debt options, and you want a manager to take that hassle for you, and you are happy to give 1%, 2% asset management fees in return. Mutual funds are great for busy professionals. So moving on, one very important asset class which nobody mentioned was your own business. And this happens when we talk about investments. We generally think of shares, mutual funds, gold, real estate. I think the number one consideration should be your own business, because you are in the driver's seat over there. Risk is best known to you, returns are in your control, and you're presumably going to be in for the long run. So N is taken care of. Um, for people who are in salaried jobs, obviously this is not relevant. But for anyone who has his own private practice or runs a hospital or nursing home, or any other business venture, there are a lot of doctors who actually have side ventures. Your own business is obviously a place you want to consider when making an investment. I just thought about discussing three or four concepts under this head. This is because everyone's business would be very different, so it's very difficult to have a discussion which will make sense to everyone. But these four concepts are actually concepts which are likely to be common to most businesses. The first concept is of payback period or break-even analysis. This comes into the picture when you are thinking about making an investment into a new center, a new device, a new machine, sometimes even a very expensive hire. So, but let's talk about this more in the concept of a machine. So, how do you decide whether you should buy this new, whatever, 64 slice, 128 slice CT scan or not? So, a very simple analysis will at least get some clarity on this. And the way you do this analysis is you take the cost of that machine, and this is very simplistic. There will be more complication and nuance, but just for a conceptual framework, you take the cost, you take the life, you project volume over that life, you project pricing over that life, you think about your cost, variable cost. Now, I should have actually put this down in a slide, but let me explain this. There are three, four concepts which are worth understanding. Um, so the first we said life. So let's take this example of CT scan. Let's say the machine costs 3 crore rupees. This is a refurbished something you are getting. Now you're going to put 3 crore rupees, and you guess that this will be handy to you for 5 years. After which this machine will either demand too much maintenance, or the technology gets outdated, and therefore you have to sell it for scrap. So the first thing you do is project your volumes in the 5 years, and it's a good idea to do this on a quarterly basis, or at the max on a yearly basis. So let's say you assume that in my first year, I'm going to get 10 or 20, 20 CT scans a day, 20 scans a day, which increases to 25, 30, 35. And there has to be some logic to this assumption. The logic could be the center next door is doing X volume, or average centers in my city are doing X volume, or my current center my current machine is already full capacity and I easily expect X volume, whatever. So do that, project volumes, multiply it into pricing. So take average pricing. There'll be CT abdomen, CT thorax, CT brain. There'll be contrast. All of that will be there. So take average pricing, and this is called realization. So when you take average across multiple categories, it's called realization, average realization. So take average realization. Average realization may not be a single price point. So your price points might be 3,000, 7,000, 10,000. But you take a weighted average that I'm going to sell 10 scans of 3,000, 5 scans of 7,000, and 3 scans of 10,000. So my weighted average comes at around 5,200 rupees, let's say. So 5,200 is your average realization. 3,000 scans a year is my expected volume for year one, 3,500 for year two, and so on. So go to year five. Now calculate how much cost you will incur in providing each scan. So average realization is 5,200, but what's going to be the cost of each scan? And here there are two kinds of costs. So there are fixed costs and variable costs. Fixed costs are the cost of the technician. That's a fixed cost. The space of the room where you actually put this machine, or you may actually rent a new facility to put this machine, the rental for that is fixed cost. Electricity is a variable cost. Electricity you'll only incur if you'll run the machine, otherwise you'll not incur it. But technician cost you'll also incur if there is a lean season or if there's a peak season. So fixed cost is something which does not rise in the same ratio as your revenue rises. Variable cost is something which rises in the same ratio that your revenue rises. So when you deduct your revenue, when you deduct your variable cost, you will have maintenance cost, which is also a fixed cost. So there will be a lot of fixed costs. There will be very few variable costs in the case of a CT. But if you take some other examples, so if you take, for example, angioplasties as an example overall, then the cost of stent becomes a variable cost in the angioplasty cost. So because for every angioplasty I put a stent, and therefore if I charge 3 lakh rupees for an angioplasty, then I'm going to incur X cost for the stent. So but in the case of CT scan, the variable cost is actually very low. It's just the electricity cost and some contrast cost and some changeover cost, etc. So you can safely assume that only 5% or 10% of the 5,200 rupees is going to be your variable cost. So you deduct that 5% or 10%. So you say 5,200, maybe you remove 700 rupees on the safer side. So 4,500 rupees per scan is your contribution. Okay. Contribution is what you get when you remove revenue minus variable cost, VC. So revenue minus VC is contribution. Contribution is your real earning. Variable cost is not even your earning. So contribution is your real earning. You have to calculate the entire contribution over 5 years and add all the fixed cost to your initial 3 crore investment. And then you figure out at which point, at which month in the next 5-year period, is your contribution going is your 3 crore plus fixed cost going to be recovered. So always do this. This might sound a little difficult, but if you just search for break even analysis or just search for contribution or payback period, I think you will get a very easy way of doing this. And just start doing this back of envelope. Don't try to make very complicated excels or anything. It's okay to be fairly light on this, but it's important to do this. It's important to have a sense of break-even analysis. Second is opportunity cost, and this is one of the most missed concepts, especially among self-employed people. So opportunity cost is the cost you incur in something when you don't think about what else that something could have got you. Now, I'll give you two examples. So when you want to start your private practice, and you'll figure out the cost of clinic, the interiors, the receptionist cost, etc., but you'll not think about your salary. If you were working at a corporate hospital, Apollo, Fortis, Center for Sight, wherever, you would have made yourself 3 lakh rupees a month. You need to consider this 3 lakh rupees. I'm not saying you need to be obsessed with it. I'm not saying you should not do something else but you have to keep that in the formula somewhere. You cannot ignore opportunity cost. Opportunity cost is most frequently missed in three cases. Your personal opportunity cost. What could I have made if I was somewhere else? Is a very important question to answer. Second, the second opportunity cost you miss is the rental cost. So a lot of times doctors buy clinics, they don't rent clinics. The reasons for buying are many. It starts with emotional, it starts with insecurity, saying what if I rent it and I build it out and it starts doing really well and the landlord asks me to vacate. So there are many reasons, and I understand the reasons why people would want to buy. A lot of times you have that excess money which you want to deploy and therefore you buy. But when you buy a clinic, and then when you start doing break-even analysis or profitability analysis, or figuring out when you start making money or start celebrating. So in 15 months, you celebrate saying, in 15 months, I have now broken even and I'm profitable. You should also consider what would you have made if this place had been rented out to a bank. The bank would have been giving you 1 lakh rupees. And what if you were somewhere else? Assume you are not on the second floor where you have actually bought it, and you gave it out to a restaurant, and the restaurant is giving you 1 lakh rupees a month in rent, and you just move one floor up to the third floor. Now, are you going to pay the same rent in a different building, in a different location, a kilometer down the line, a lot of times the rent you can make is something which is missed out in our calculation. So you should always think about the rent that your place could have made if that place was put somewhere else. The third opportunity cost you miss is the cost of your capital. So when you put 3 crore rupees in that CT scan, you should start thinking that, in the worst case, the 3 crore rupees would have made me 30 lakh rupees a year. Not the worst case, but an average case. 10% is what we all expect to make, right? So when you start doing your profitability analysis, I think it's very important to think about opportunity cost of various kinds. So always, and I think the word is quite self-explanatory, which is the cost of missed opportunity is the way to think about it. Moving to the third concept on sunk cost. The easiest way to explain this is through a proverb which we learned in school. There is no point crying over spilled milk, is the proverb. So spilled milk is sunk cost. You you opened a new center in a very upcoming locality of your city, and for various reasons the center didn't work after 3 years. Now this is spilled milk. The wise decision is to shut down the center, but we will put good money after bad, and we will stay invested. Here it's very, very important to think about sunk cost. Sunk cost is in some ways the opposite of opportunity cost. You have to realize that there is no way in the world that you'll recover the money you've lost. The only thing you can do is make some money now, and that's the hope. But trying to recover money which you've lost is futile. That money cannot come back, you know so unless something has changed, unless there is a reason, you invested in an equipment, you thought a certain service will work, so you expanded from being, say, a gynec center to an IVF center, and the IVF demand didn't pick up. The logical thing to do is to shut it down after you've realized that the demand isn't there, the pricing isn't there, there's too much competition, you're not able to attract a good embryologist, whatever is the reason. But hanging on too much to a bad decision is basically what compounds sunk cost. And these are very deeply researched and deeply discussed concepts of economics. So if you'll just search for sunk cost, you'll find a lot of good articles and good cases and good literature. So do that. And finally, the buyer rent, which I discussed earlier when we talked about buying a clinic. Uh, for reasons which we understand, it's more comfortable to buy property. Uh, Most corporate chains, however, generally do not buy property; they rent. And if large hospitals can get built, if 300-bed hospitals can get built on rented property, your clinic also can get built on rented property. So it's not really necessary to worry too much about your landlord asking you to vacate. There are reasonable social and legal provisions, and you should get into a longer lease in the first place, and you should get into that understanding with the landlord that I'm going to be here for 20 years, 10 years, 30 years. So uh, rental is good because a lot of times the argument behind buying is that my capital will anyway get appreciated, and there is safety and everything else. But the argument against it is that a lot of times the place to do business is not the same, or the best place to do business is not the same as the best place to earn appreciation on your property. So if I am in Ahmedabad, and I can give you an Ahmedabad example and you can relate it with your city. So in Ahmedabad, the best place to open a hospital today would probably be SG Road, or probably be center of the city. The best place to put your 2 crore rupees into a property will probably be the outskirts, somewhere 10 kilometers outside of SG Road, where appreciation is happening very fast. But you can't build a clinic there because no patients will come there. So it's not completely nonsensible to say that I am going to take my 2 crore rupees and put it in a place where the money will grow faster, and I might send it out on a rent. And here I am taking a clinic somewhere in the center of the city, and I am paying rent for it. it it's good. It's not a wrong idea to think about it like that. Having said that, there are many personal considerations. So this is not about saying always rent, but this is just saying that consider renting at least. So on insurance, just want to talk about one topic today. There are many types of insurance. Uh, uh, there is health, there is life, there's general, there's car, there's property, there's so many things. Let's talk about life insurance and specifically term insurance inside life insurance. Term insurance is also called pure cover. The reason it is called pure cover is it only covers your life. It does nothing else for you. So a typical term insurance is a plan which will insure you for anywhere between 7 to 10 times of your annual income. So if, say for example, your annual income is 20 lakh rupees, you should go and take term insurance for 2 crore rupees. And the premium for this ballpark will be 20,000 rupees, 25,000 rupees, depending on your age. If you are young, it will be 25,000 rupees. As you grow older, the premium will grow older. The policy will cover you till 70, 75, 80 years. And if at any point before the policy termination, 70, 75, 80 years, uh, let's say in an unfortunate event, uh, you know more, your family gets that entire sum assured, no questions asked. The only thing you need to provide to the company is the death certificate. It doesn't matter how you died. It doesn't matter whether it was an illness, an accident, even suicide is covered after the first year. So term insurance is a very, very important product which every single person should have. Every earning person should have term insurance, because term insurance ensures your family's source of income. It doesn't insure you. Term insurance cannot make sure that I will not die. Term insurance will just make sure that if I die, my family's liabilities will be covered, because my family was depending on my 20 lakh rupees a year. My 20 lakh rupees post tax would be 14 lakh rupees. So my family was depending on these 14 lakh rupees for various things: tuition, school, etc., healthcare, everything. Now, suddenly you are no more. Where does this 20 lakh come from? And this comes from the 10x cover. So the insurance company will pay you 2 crore rupees. 2 crore rupees put in a good FD will give you 20 lakh rupees a year. So the person cannot be replaced, but at least the income stream can be replaced. Now, this comes at a cost. This comes at a cost of 20,000, 25,000 rupees. It's best to get into term insurance as early as you can, maybe at the age of 20, 25, 30, 35. Because the earlier you get into term insurance, the cheaper the plans are. And the good thing about term is your EMI or your annual premium is the same throughout your life. Even at the age of 80, you will be only paying 20,000 rupees as your premium. So the commonest problem that people have with term insurance is, what if I don't die by 70? It's a good thing you didn't die by 70, because you survived your entire period of livelihood. You while your family was depending on you, you survived, and that's a great thing. You don't have to get money back from everything. The problem with schemes which give you money back at the end of your term, at the end of your policy period, is that there are two problems. One, they cannot give you a 2 crore cover. So let's assume that the premium is the same. Let's assume that premium is the same 20,000 rupees. A policy which will give you money back in some form cannot give you 2 crore cover. It will give you 10 lakh or 20 lakh rupees insurance. 20 lakh rupees insurance, when you die after 10 years, will not be enough for your family. It will be hardly 6 months of or 12 months of running money for your family. It's not the same as 2 crore rupees. And the second problem is, the money you will actually get back after the policy is over at 70 or 75 is peanuts. Imagine getting back 10,000 rupees today from your Wipro investment. What would 10,000 rupees be worth to you today? So that's the problem. So at the age of 70, you will get back your 2 lakh rupees. What will you do with 2 lakh rupees that you put in? So there's a huge problem with insurance, and it's best summarized in this slide. There are certain things which should never be mixed, and insurance and investment are two such things. Both are important, but do them individually, do them in the best possible place. The best possible way to insure yourself is term insurance. The best possible way to invest is up to you, depending on your risk profile and how you assess things. So I think I'll just summarize with that. Wealth and income are separate. Wealth is what we create over time. If we deploy our income well, uh, wealth builds over time. Compounding is the most powerful law of finance. If we can't do anything else, if we can just get into an SIP and put 10,000 rupees or 5,000 rupees every week or every month, we will definitely generate wealth. Uh, risk should be reduced with age, generally, as a rule. Uh, Never forget to invest in your business, get yourself a term insurance, and do not mix insurance and investment. Uh, I'll end my presentation with that. And please write to us with what topics you would like a deep dive on. So we discussed many things and we didn't discuss many things. Whatever you want a deep dive on, please write to us and we'll make sure we have a very competent person from that sector. We have a lot of associates in crypto, in mutual funds, in credit cards, in business loans, everywhere. We'll get the best people to present on it. So with that, I'll end my session and let me take some questions.
Thank you so much, sir, for the educational presentation. I am sure many of them have cleared their basics. We also have a very interactive audience today. There are some doctors who have really given some good quotes. Dr. Narayan says that compounding is the eighth wonder, as said by Albert Einstein. Dr. Avnish is saying that bad decision is better than an indecision. So it's really good that people are interacting with us. And also, there are a few questions. I would also like to state to the audience, doctors, if you want to come on stage and ask any question, you may please click the raise hand on the right side of the screen.
Okay. There are a few questions. I can take them.
Yes.
So there is a question on, are private insurance companies honoring the claims? So Dr. Jayasudha, IRDAI is a uh, uh, fairly strict watchdog on the insurance sector, and apart from what they would probably be doing to make sure that the claims are honored, the one thing is that a lot of this data is public on IRDAI website, so you can look at all term plan companies on IRDAI website, and you can see their claim settlement ratio. And that will give you a very good idea about the percentage of claims that particular plan is that particular company or insurer is actually honoring. It's a very good question. There is no need to assume that once you take a term plan, you should sleep in peace. There will be, you know, uh, a spectrum of ethics in every industry, and insurance is no different. So uh, there might be companies which are habitually rejecting claims. I think it's a good idea to check the claim settlement ratio, or at least ask for the claim settlement ratio on the website. The next question is, when do you close all investments and consolidate? What is the right age to do this? I think, Dr. Ravi, the right thing to do is to move more and more towards safer investments as you age, but there cannot be a right, I mean, there isn't really a Lakshman Rekha. It very much depends on what Dr. Narayan has also mentioned, the number of financially dependent people on you. The more people are dependent on you, the more important for you to safeguard your investments. The lesser the dependency, the more the riskiness. I think I can only answer this for myself. It's very difficult to answer this for as a general rule. But I think once I've set aside what I think as enough money for my close family, and close family is not often your immediate family. A lot of your extended family members actually will expect you to help. So I think the moment you have enough money, in today's terms, it might be maybe a few crore rupees, because some of the costliest healthcare interventions can be really expensive. Uh, we've all heard about these spinal SMA drugs costing 10 crores plus. Uh, but even if that's a very rare thing, even normal renal liver transplants, etc., or some of the leukemias, etc., the cost will run into a crore plus. So I'm assuming a few crore rupees will be necessary in today's terms to put aside, but this number will only keep growing with time.
Dr. Vasudha would like to ask what are the investment options for medical interns?
I mean, medical interns, I'm assuming the reason you're asking this question is that the investable corpus is small. If that's the reason you're asking the question, because otherwise interns are no different from anyone else. But probably the question is that where can you put in if you have 5-10,000 rupees to invest after expenditure. Um, Most of the cases, Dr. Vasudha, the investment asset is not really a function of the money you have. I mean, real estate is an example where you probably can't get into with that kind of ticket size. But you could buy mutual funds, you could buy shares, you could buy, I mean, you've seen the crypto ads. You can also buy crypto for 10,000 rupees. So it's not so much a function of the money you have to invest. It's more a function of your personal risk profile, what you like. And it would be really wrong for me to give any one answer here because nobody knows right. Nobody knows the best thing. Somebody asked about crypto also. And I think the question was that will it keep growing? Um, Okay, let me before that, is recurring deposit the same as compounding? Yes, it is. So recurring deposit means that so in fixed deposit, after the tenure is over, the money comes out. In a recurring deposit, the whole money along with the interest gets reinvested. Investment option in medical field. Dr. Hardik, if you could make it a little more specific, because uh, are you asking as a financial investor? Then the answer would be different. Yeah, residents earning around 60K, how much should be invested every month? Uh, Almost all of it should be invested. Early on with minimum possible liabilities. Just take out bare minimum for your day-to-day expenses and put all of it in some class. Um, you'll be able to start your own practice sooner. You'll be able to buy your house sooner. So yeah, the answer is going to be as much as possible. Is crypto gonna grow? Nobody knows, Dr. Muskan. So uh, I think crypto is a very, very difficult asset class. Uh, it's been extremely volatile. It's been up and up, and then it's had near death experiences multiple times. Uh, Generally, you should invest in asset classes which you understand. Crypto is something which very, very few people actually understand, and therefore it's very, very risky. Having said that, risky doesn't mean bad. It just means that you need to understand that there is a real chance that you might lose this money. If if there can be a 2%, 5% of your money which can be put in crypto, it can be put in crypto. If you must put in crypto, then I would always suggest going for some of the older cryptos, which have been established now for a really long time and which have a lot of volume, rather than some of the newer cryptos which have more, which are growing more crazily. Many of the newer cryptos will survive and will give crazy returns, but 100 times more of them will actually not survive and will lose your money. And the problem is you'll not know which are those 10 which will survive. So that's the problem in hunting for the right crypto. So the best is if you can just put 2-5% of your allocation into some established crypto. The question, however, is wrong. Is it going to continuously grow? Nobody knows. You when you do crypto, you know you're speculating. That's the important thing. It may grow, it may not grow. If there is a guaranteed answer, then the whole world is putting money in there, right? So if you do it, please do it with the understanding that it actually might wipe it out completely. And therefore, just put 2%, 5% of your money there. Even in the worst case, in the best case, that 2% or 5% will become 100%. And in the worst case, you'll lose that 2%, 5%. So, um, yeah. Okay. Uh, Dr. Hardik, that's, I mean, I'll skip that question because it's more a business question than a financial question. There will be a lot of case specific risk you'll have to think about. So for example, what if you buy that equipment? So his question is, can we he's just giving an example of business investments in the field of healthcare. The logic is that we as doctors understand healthcare well, and over and above our own professional practice, is there some other area where we can deploy some money and probably and as an example, he said, for example, if you have the capital, so you buy that CT scan, and then, or CT scan may not be the right idea, but something, and you rent it out to people who probably don't have the capital. Uh, it's a uh, it's a financing business, Dr. Hardik, and the problem with a financing business is the underwriting risk, right? So if that particular thing loses demand or becomes obsolescent from a tech perspective, then you're stranded with something you don't understand, and you can't do anything about. So I mean, it's very difficult to give a. I mean, there are no top of mind things, but if you're very uh, focused or keen on healthcare, then investing in some healthcare stocks, either in diagnostics or pharma or hospitals, might be a better idea, because it's at least a space. If you will read their annual reports, it will at least make sense to you, compared to a cement annual report, which probably might not make too much sense to you. Diagnostics, as we all know, has grown really well over the last year or two, and that growth is expected to continue. In terms of the demand growth, I'm saying, not the share price growth. The demand growth is expected to continue because the sensitization of that whole diagnostics role of diagnostics has happened in the public's mind. So super. I think we'll then it's exactly 8 o'clock on the dot. So we'll just wish everyone a very happy Diwali and call it a day for now.
Good evening, sir. I am Dr.
Yes, Dr.
Narayan.
Narayan. Yes, yes, yes. Hi.
You are doing a fantastic job, sir.
Thank you so much, sir. Very kind of you, sir.
Actually, I just wanted to let you know that I would be happy if you can arrange for a session on income tax.
Yes, yes,
Because we do
absolutely.
have.
Noted, noted. I think it's a very
Okay,
broad
thank you.
topic. Yeah, definitely.
And I was just expecting few questions in the quiz today, but we had only one. Yes. Okay, thank you, sir. Great.
Thank you so much.
That's all I wanted to say. Thank you. Bye.
Okay.
Yes.
I think that'll be it. Thank you so much,
Yeah.
everyone.
Thank
Good night. Have a
Thank you, everyone.
weekend.
So, along with today, we learned along with mental health and physical health, to maintain both of them, we require financial health. So, I think it was a very good session.
So we'll just end the session. Thank you all
Yes.
very much.